Hi everyone, John Boardman, founder and CEO of Ballast. I'm here with Andy Reynolds, partner and chief operating officer. And obviously there's been a lot in the news about the markets, and we just wanted to record a little video today to talk to you about sort of our observations, what we're talking to clients about, and sort of where we see the rest of the year going and what that means for investors and from a financial planning standpoint as well. So Andy, just kind of open it up to you. You know, what do you see out there right now? What are you talking to your clients about? We've got a variety of clients, ages, and objectives. So, reactions to this market are obviously going to be very different.
Yeah, I think, depending on where you are in your life cycle, whether you're an accumulator or distributor right now, it's really two different perspectives, but really everything kind of comes back to the same narrative of where are we going and how are we getting there. The Fed continues to be the driving force of what's happening in the economy, what's happening in the market, and really everyone trying to figure out that variable first. So, there's a lot of stuff out there, from geopolitical risks to just pure economics, supply and demand, to housing, to the labor market, and there's a lot of variables at play. But I feel like the conversations keep coming back to is what's the Fed going to do? The summer rally, when we recorded our last video, it was a nice little rally starting in June, going through the summer months. That flipped on a dime with one piece of data, but really that data came back to what's the Fed going to do? Mm-hmm. And so really I think that's the biggest part is what's going on in the economy in the short run, the next, through the end of the year, the next 6 months, is what is the Fed going to do with rates? When can we reduce the headwind of the Fed and the Fed intentionally trying to slow the economy? When that happens, we can start to really see what happens with the economy. So I feel like a lot of our conversations keep coming back to the Fed from an economic standpoint, just because it's the loudest variable out there and the most impactful one for the next handful of years. That being said, there's a lot of variables out there at play as well.
Yeah, I mean, it's not just looking back at history and interest rates, it's not surprising that the markets would have this level of reaction to the Fed really pouring this much cold water on the economy. That's really what they're trying to do. They're trying to bring asset prices down and do whatever they possibly can to bring, obviously, the inflation figure down as quickly as possible. The difficult part for their job, though, is that there's typically a lag effect. As you increase these interest rates, and it might take 12 to 18 months before you actually see the net impact of that. But we've had interest rate hikes, but we haven't had this level of hike in over 40 years. And that is not something current investors are accustomed. I mean, we obviously have clients who were investors 40 years ago, but that's so long ago where we actually had to deal with an environment where it felt a little bit like the Fed was our enemy. I don't believe that's the case, but I think in the short run it feels that way because unemployment numbers are strong, and outside of inflation, most of the economic data is pretty good. So, but there are obviously concerns around that number. It's an issue they haven't had to contend with, like I said, in over 4 decades. And I think they felt a little behind the curve. It was clear in the statements they made last December that they thought that this was going to be transitory and largely due to supply chain issues. And I do think some of that still is in play, but I think they came to an acceptance this summer, and particularly in the August report that you noted, when they really were not seeing progress and food prices were still up, and haven't obviously seen cost of housing come down much at all. There is a belief at this point that the Fed is just going to have to continue on this pace and increase at this, whether it's 3/4 of a point at each session, at a market rate that I don't think anybody a year ago, would have predicted.
And I think what's hard is they're dealing with 3 different periods of time. They're getting old data that they're having to make decisions in real time on. But as you noted, those real time decisions won't be played out in the economy for months ahead. So it's a tough job.
It's a brutal,
one I don't want.
Job.
But figuring out how to do enough to where we don't have just runaway inflation, which you talk about things getting more expensive now, inflation really ramps up. That could be a screeching halt to the economy.
Absolutely.
So we don't want that, but at the same time, we don't want to do too much that the opposite happens,
Yeah.
and it's a screeching halt because things got too difficult.
Yeah.
So, talk a little bit about the markets, and I think it is very natural for everybody to look at headlines, see the things on the news, look at a monthly statement, quarterly statement, and get so hyper-focused in the now. Talk a little bit about markets and a little perspective on those.
Yeah, I mean, obviously it's been an ugly year. I mean, it's been the first year in a long, long time where we've actually had bond markets and stock markets retreat simultaneously. So we've higher interest rates, that's impacted bonds, they've come down, and obviously stocks have been under pressure most of the year. 2021, I think, was a shockingly positive year. I mean, if you think about the year prior to that, and we were really in the midst of COVID in so many ways, it's really surprising to see where the indexes did really in the year in 2021. We spoke earlier in the year about this development that I do think is healthy, that a lot of the trash in the market is getting flushed out.
Yeah.
There were a lot of companies trading at multiples that were completely unjustifiable. Probably companies that went public that should have never gone public, did not have the fortitude and sort of were not established enough really to justify that. But the market was accepting of that. Valuations were really high for IPOs. So a lot of these tech companies went public. There was a unknown of how COVID would play out, and I think if you look at a lot of the names that have been punished most this year, they were the darlings of COVID. They were the names that got there was so much excitement around this idea of working remotely or people doing things from home and not traveling. That, I think, has been washed away quite quickly. The NASDAQ at one point was off well over 30% year to date, and I don't even think that tells the story of how ugly some areas of the market are. There are landmines everywhere, companies that are off 60, 70, 80, 90%. That are household names within the tech industry. I actually think that's a positive development that those are getting exposed. I mean, at some point, you have to have fundamentals play through and how stocks are valued in the overall market. And I think what we're going through with this higher cost of capital and interest rates increasing is the market now using a much more discerning eye on how stocks are valued. And it is starting to expose some real value in the market. Now, that doesn't mean as investors, if we go there, that we're going to immediately be rewarded for that. Very few individual investors could push the needle on a single stock. So it is really about, in any sector or stock, it's about positioning yourself before the herd gets there. And we do believe that when the news does get a little quieter, which it will, this too shall pass, as we say, that there will be, the markets will start looking for real value and real quality. If we look back to most bear markets that were over 25%, you will typically see that the rally and the areas that rally are not the areas that led up in the previous market. So financial crisis, tech bubble, COVID, you had these, the assets that sold off the most tended to not be the ones that came back the strongest. So I think people who are just sitting there in the midst of this, I think that is a mistake. So that's something we're trying to do right now, is think about what are strategically, where do we want to be positioned as we move forward. But so much of this is psychological. I mean, we've basically gone back to where we were a couple of years ago. And if you add dividends in, it's been a quite positive period of time. One just technical observation of the market is typically we would see the VIX, the volatility index, reach over 40, sort of the panic measure in the middle of a bear market. That's happened the last, I think, 27 or 29 years since the VIX has been measured. We haven't reached that level yet. It doesn't mean we necessarily will. I do feel like this is a little bit of because it's sort of an elongated sell-off. If you look, it just feels like stair steps down for the year. We may not have that moment of panic, but it's just an observation. And also to tell people, things could get worse before they get better. Usually markets overshoot in both directions. They don't necessarily know where they need to bottom. They don't know where they need to top out. So investors are a little emotional. Markets are emotional. So that it is not impossible that we would see swings worse than we have recently. But Also, most bear markets only last about 15 months. I mean, that's a typical average. We just went through the shortest bear market we've ever experienced in COVID. I think it was 33 days.
Yeah.
And that's why I don't think investors really saw much in that, right? Because it just happened so very quickly. So talk a little bit. I know you said some numbers that you were talking about as it related to market returns and kind of how the S&P's been doing over the last few years. And just to give us some historical perspective.
Yeah, and I think talking about that, so going back to the end of last year, so I think at the end of last year or shortly thereafter, or even going back to the beginning of COVID, just thinking back to pre-COVID, end of 19, beginning of 2020, the market's higher from there. And I think if we would have told anybody what was about to happen and say, hey, look, your portfolio is going to be higher in a handful of years, I think most people would welcome that and
Right.
applaud that. I think also closing out, 2020, beginning of 2021, if we said, look, close down the markets for 2 years and we're going to wake up, we're going to be at the same levels, going back to the bottom of the financial crisis, the market needed to take a breath.
Yeah. And noting all the issues that were out there
No,
too.
exactly.
Yeah.
And,
let alone
and all the
Fed.
stimulus money that came in. So I do think that is important to recognize. Counting dividends, I wrote these numbers down today. Counting dividends, year to date, the S&P is down 19.5% as of today. Just go back a couple years. Over the 3-year average, the S&P's up 10.5%, counting dividends, not point to point, but including dividends. So, the getting hyper focused on short periods of time is so challenging as an investor because it can lead you in multiple different directions. And right now is the time, as we've always said, but really right now is to remain disciplined. We come out here and we do these videos and we talk, we have opinions. But predicting what the market's going to do at any given point is nearly impossible. The thing I always go back to is when Trump won the election, there was a poll in the Wall Street Journal of 1,000 economic pundits. 3 of them thought the market would go up.
Yeah.
The market rallied.
Yeah.
And so trying to predict what the market's going to do at any given point, even though we may say, hey, look, valuations are crazy, we want to be tactical with that. But trying to jump in and out, trying to make a big, bold prediction, I think is really where the true harm occurs. Just look back over the past 2 days. If you're out of the market, you just missed a 5% return.
Right.
And, maybe the market goes back down, but then you're starting to root for the market to go down, and it becomes this big emotional game.
Yeah.
So, historically speaking, the markets are past couple months and this year has not been enjoyable, but the market still has done really well if you put a little perspective behind it.
Yeah, it's part of market cycles. I mean, it's no fun. I mean, no one likes to watch. I mean, it's exhausting for investors, investment advisors, but as you said, the best thing we can do is stay process oriented, stay disciplined, and as unemotional as possible.
And on our side, we need to be looking for the tactical moves. We need to
of course.
The undervalued positions.
Yeah.
That's what we're doing internally.
And basing that on fundamentals, not
Right.
emotional swings.
Correct.
Which I think, or pundits, who
Correct.
say things that they like. They want
It's on the news.
They want to gather clicks or whatever it might be.
Right.
I think the forward-looking nature of markets is always what baffles investors the most. Most people think that the stock market is a measure of what's happening today. It is not.
Right.
It is a measure of what the markets believe the underlying companies inside the market will be doing over whatever period of time that might be, 12, 18 months, 5 years, however those individual companies are being looked at. So when we look out the window today, we don't see a really bad economic environment, so why would we see equities sell off as they have? It could be, to some degree, a prediction of economic conditions to follow. But at the same time, it is also reasonable to believe, because it's happened often in the past, that markets will actually start to recover in the midst of poor economic conditions.
And could recover quickly.
And very quickly. And so that's the failed narrative around trading economic data, is that you will typically see markets working inversely to economic conditions because, again, it's looking ahead at some future period of time. And sort of depending on the risk level of the market, the volatility of the market, I think that has a direct relationship in how far out or lack thereof it is looking. So what are some things, from a client standpoint, planning standpoint, the client should, as we're going to be having a lot of conversations with clients, through the end of the year and talking about portfolios, but also there's a lot of planning work that can be done in the fourth quarter. What are some things that we're focusing our efforts on right now?
Yeah, so I think, it kind of comes back to those two different types of people, accumulator, distributors. One big thing, focus on control what you can control. We can't, I wish we had a button that made the market go up.
Sure.
We don't have that. So what can we be doing internally? So what we're going to be focusing on is looking for value in the markets, looking for the part of our portfolio we're tactical in. We're going to be looking for good economic trends that we can take advantage of. From the client planning perspective, nothing's changed. When the market was up, we were looking to make good decisions when the market was up. When the market's down, there's equal opportunity, sometimes better opportunity to make good decisions from a planning perspective when the market's down. Talking about doing Roth conversions, talking about making contributions this year. If you have the ability to pre-fund things now through the end of the year or now for the next couple of years, if you're an accumulator of 529, if you have the ability to make your 5 years of 529 gifts, now's a great time to do that.
Yep.
And hopefully, you get a benefit from that on the rebound. Tax loss harvesting. We've had multiple positions that we're trying to work out of for clients, but we haven't had losses to offset the gains with, or those positions have just done so well that it's hard to get out of them because they're so large. So not that we want to sell low, but if we can sell at a lower point, diversify into something that has less non-systematic risk, but still has upside potential, it's a great opportunity to really work on the portfolio for the client, given that we've been the portfolios as a whole have been really strapped because of capital gains for the past couple of years. It's been a long time since we've seen losses in client accounts, but because of natural rebalancing and trading, we have short-term losses that we can use to fix portfolios that may be underweight in certain asset classes or whatnot. So there's ample things to do even when the market's down, and like I said, sometimes more things to do. Just like when the market was up, we're talking about gifting, we're talking about paying down debt, we're talking about taking advantage of appreciated securities through charitable ideas. So there's always a meeting yesterday with someone, and they're like, we just retired, it's cruise mode for the rest of our life. I was like, well, here are like 3 things we need to be working on. Actually,
there's always something.
There's always something.
Yeah.
And if you get complacent and you either stick your head in the sand or complacency when things are going well, that's really where you miss the opportunity.
Yeah. I mean, you mentioned gifting. I had a conversation with a client yesterday. It's actually, if you think about share prices being down and the gift limits, you can actually give more away, without any tax implications. And one question we've had for a number of clients is just, am I still on track?
Right.
And I feel confident saying everybody we've sat down with is still on the path that we wanted them to be on. We don't look at this as a straight line projection of where our client's going to go. We understand there are going to be good years and bad years and everywhere in between. But it's a wonderful opportunity, particularly for someone who might be a little bit anxious, to let us just retest the numbers and look at the portfolio. I think so much of these market pullbacks, because they typically are always temporary in nature, it's psychological, right? It's this idea that you're taking a step back, and we had these nice account values at the end of 2021. That becomes the new high watermark by which clients and investors think about their financial picture. And the reality is it's a curvy road to get there. And it's really more about going up and down mountains, ideally with the highest peak being at the end here. So it's an anxious period for people who are getting ready to retire, have just retired, or maybe who are newer investors. Maybe they were real estate investors and became equity investors a couple of years ago. We fully recognize that. But our job, and I think we've done a great job, is to stay disciplined, and I think we like those conversations with clients, so we can sort of reinstill that confidence in them.
So I would say communication.
Yep.
So if you're feeling anxious right now, give us a call. We
Yep.
can talk through the anxiety, and 99% of the time, the anxiety, when you take a step back and think through it rationally, that can be alleviated. Sometimes maybe we make a tweak. If you're feeling so anxious about something that we can easily make a small change and it relieves that anxiety, we can do that.
Yeah.
So just communicate with us, and we're doing this to try to open those lines of communication. Pick up the phone. We're always available.
In our portfolio management strategy too, we've talked about this for years, that in the event of a market pullback and we have a client that needs liquidity, how would we combat that? So we have plans in place, to do that safely in a way that we don't think is detrimental to their long-term plan. So, that's why I think we are somewhat unemotional in these periods, because I think we've been talking about this happening for some time.
Yeah.
I think we thought COVID was that. It just recovered quicker than I think anyone would have.
And that's a great
anticipated.
example of why you don't overreact. I mean, generally a brand new thing. I know
Yeah.
there's Spanish flu and whatnot,
Yeah.
but in today's world, a brand new, scary period of time. Had we have overreacted and gone to cash, which would have been warranted or something like that.
Oh, they were calling for potentially the next Great Depression.
It would have been a horrible decision.
Yeah.
The market
It would have been a very.
So it's
good
the same. It's the same thing. Nobody knows
Yeah.
how the world's gonna go. I think we're generally optimistic about the future.
Yeah.
But let's be smart about the way we do it.
Yeah, and this market pullback, I think, is just one people haven't seen in a while, right? It's
Yeah.
that death of 1,000 cuts. It's
Yeah.
just been this slow sort of journey down, and I think from novice investors are probably trying to figure out how you call the bottom of this,
Right.
and I think that's a mistake. I think that has proven to be very difficult, and I think particularly in this environment will be almost impossible. So. Well, that's all we have for today's video, and we appreciate you listening in. And of course, as Andy said, if you have any questions and there's anything we can do to help you, please reach out at any time. Please visit our website at ballastplan.com. That's where we house all of our Athenium videos, various financial planning topics, as well as our commentaries, and that's where this video will also be housed. So thank you.
Thank you.